Assalamualaikum warahmatullahi wabarakatuh. My name is Puspita Dewi. I am from class Accounting B. Adjusting journal entry. What is adjusting journal entry? An adjusting journal entry is an entry in financial reporting that occurs at the end of a reporting period to record any unrecorded missing income or expense for the period. When a transaction is start in one accounting period and end in a later period, an adjusting journal entry is required to properly account for the transaction. Adjusting journal entries can also refer to financial reporting to correct a mistake made previously in the accounting period. An adjusting journal entry is also known as a balance day adjustment. The purpose of adjusted entry is to show when the money account actually changes hand and to convert real-time entries to entries that reflect the actual accounting system. An adjusting journal entry involves an income statement, account, revenue or expense, along with a balance sheet account, asset for liability, and typically relate to the account for accrued expense, accrued revenue, prepaid expense, and unit net revenue. The entries are made in accord with the matching principle to match revenue and expense in the period in which they occur. The adjustments made in journal are carried over to the account ledger and accounting worksheet in the next accounting cycle step. A common characteristic of an adjusting entry is that it will involve one income statement account and one balance sheet account. Income statement account that may need to be adjusted include interest expense, insurance expense, depreciation expense, and service revenue. Balance sheet account that may be adjusted at the end of a reporting period include account receivable, interest payable, accumulated depreciation, and prepaid insurance. In summary, adjusting journal entries are most commonly of three types: accrual, deferred, and estimate. Accrual are revenues and expenses that have not been received and paid, respectively, and have not yet been recorded through a standard accounting transaction. Deferrals refer to revenue and expense that have been received and paid in advance, respectively, and have been recorded but have not yet been earned or used. Estimate are adjusting entries that record non-cash income items, such as depreciation expense, allowance for doubtful account, or inventory obsolescence can resolve. For example, a company that has its fiscal year ending December 31 takes out a loan for the bank on December 1. The term of the loan indicates that the interest payments are to be made every 3 months. In the case, the company's fair interest payment is to be made March 1. However, The fact the company is not expected to make any interest payment until March does not mean that it doesn't accrue interest for the month of December, January, and February, since the fee is set to rise in financial statement in January. An adjusting entry is needed to accurately reflect the accrued expense in interest for December. To accurately report the company operation and profitability, the accrued interest expense must be recorded on the December income statement, and the liability for the interest on must be reported on the December balance sheet. The adjusting entry will debit interest expense and credit interest payable for the amount of interest for December 1 to December 31. Not all journal entries record at the end of an accounting period are adjusting entries. For example, an entry to record a purchase of equipment on the last day of accounting period is not adjusting entry. Thank you.